Morning, everybody. This is Tim Melvin coming to you from down here in Central Florida, where we're having a bit of a cold spell. Temperatures only in the 70s after a couple weeks of consistently in the mid to high 80s. I skipped the video last week because I did, in fact, sneak over to Champion Stadium at the Wide World of Disney ESPN complex down here to watch a little spring training baseball. That's probably going to happen, and for sure it's going to happen on the 19th when I go down to Lakeland to watch the Orioles play the Tigers. So if it happens on a Monday, probably going to skip the video for that particular week. Anyway, markets are a little soft this morning after some increased volatility last week, and most of it's being blamed, of course, on trade wars, the tariffs on steel and aluminum that have been announced by President Trump. Now, reactions on this are everywhere. To some folks, it's the absolute end of the world, worst thing that's going to happen, probably going to lead to all-out nuclear war real soon. Our allies, Canada, the European Union, they're all very upset with us. And some others are saying, hey, look, we're being charged tariffs on products that we send to Germany, to Europe, to China. This is just leveling the playing field and going for fair trade. I don't know which side is right. I know that this is going to cause some further disruption in the discussion, at least, if not in the actual economy itself. Now, looking at the history of trade wars and tariffs, it is very hard for me to see where there's a winner out of these types of combats. Far better to have found a way to negotiate this, but I guess it's too late for that. You can't take this as a surprise, guys. Donald Trump told you all along there were going to be tariffs. There was going to be his version of fair trade. This is just his first shot in his war on trade. We'll see how it all plays out. Does it disrupt the economy? I don't know. I do know that anything that raises the price of a six-pack of beer is usually going to piss off the average American consumer. So we'll see how all this plays out. The stock market does not like it so far. We'll see how the rest of the week progresses as we move along towards the actual announcement towards the end of this week. And I did read an article this weekend in the Wall Street Journal, and they were talking about credit card losses at small banks. Something really interesting has happened. The big credit card banks, JP Morgan Chase, Capital One, Citi, and I guess Bank of America can go in that mix too, really are dominating the credit card industry right now. They're the ones that the A credit applicants are going to. They have more perks, more point systems, more rewards. More ATMs, pretty much more everything. So the smaller banks have had a really hard time competing. Now, what they've done, because credit cards are great business, right? It's, your cost of deposits is less than 1%. You can put credit cards out at 15, 20, 24%, 29%. So you really can make up some ground on your interest rate spread. They can't compete for the top-rated credit card user. So they've been going after subprime users. Now, subprime in banking never ends well, not going to be any different this time. We are seeing credit card losses start to grow. It's one of the few areas in the banking sector where we are seeing larger loan losses and charge-offs. Fortunately, we have stuck with fairly conservative banks in our portfolio, and none of our banks have done stupid credit card tricks. So we're in pretty good shape. It is something we watch. We watch any activity in student loans, home equity loans, and credit cards, and autos to a lesser degree, because that's where trouble shows up. When your lower-end buyers having a hard time keeping up those payments, it's usually a tell that the economy is getting ready or has already begun to weaken. So far at our banks, we don't see any real signs of that, and in the system-wide look at the banking area, credit's still pretty good. Losses may have jumped up by what looks like a big percent, but we're starting from way down here, so a big percent is still not very much in terms of real money. It is something we watch. We screen our banks very carefully. Not a big fan of the credit card business in general, because that is where you can get some pretty grievous loan losses. Most of our banks have very small credit card portfolios as part of their overall loan portfolio. Also did some very interesting research this week. The wife was up in Chicago taking care of the grandbaby so the kids could go out and celebrate their anniversary. So it was just me and the dog. And when it's just her and I, we like to get into the office, crunch a whole bunch of numbers, eat a whole bunch of bad food, and this time of year, watch some baseball. So that's what we did. So we're spending a lot of time with microcap stocks and how you isolate the winners from the losers, and just a whole bunch of fun research. And we'll talk more about it as the research progresses. But we did find something really interesting. The number of microcap stocks that are available in the marketplace at any given point in time is actually a really decent indicator of future market action. Not precise. It's not a day, oh my goodness, we're here, we're going to drop immediately, but it is a good indicator of over and underheated markets. If there's a lot of microcap stocks, that's usually because we've had a fairly decent market decline, and stocks went from 200 million to under 100 million and became market caps. And the market is it's oversold at that point, as much as I hate to use that technical term. But if there's lots of microcap stocks, say a standard deviation or so above the average number over the last 20 years, that's usually very predictive of higher stock prices a year later. Now, the inverse of that is also true. If there's not very many microcap stocks, then the market is probably, here comes one of those technical terms again, overbought, and is too high and is probably unsustainably high. And in fact, the research that I did showed that if you were a standard deviation or more below the average number of microcap stocks over the last 20 years, that was usually indicative of lower prices over the next several years, actually, of a nice little bear market developing. So where are we now? You're not going to like the answer. We have the lowest number of microcap stocks trading in the marketplace since late 2006. So just another indication that the markets are probably a little overheated here, and caution will pay, I think. That's why we're carrying a lot of cash in the portfolio right now, and we do have a tail hedge in place. Our banks are not 100% correlated with the markets, but much as a rising tide usually lifts all boats, a falling tide can often cause boats to sink a little deeper in the water. So we've been very cautious with the portfolio. I suggest that those of you playing along at home do the same thing. Great article. Before I get to the article, it's worth noting, okay, this microcap indicator, it's not the only one that's at historically very high levels. So is the market cap to GDP. So is the Tobin's Q ratio. So is CAPE ratios. Just about any indicator you can find is of global market levels is at historically very high levels. You've got to take that as a caution flag, guys. You can't just ignore it and say, well, it's lower rates. It's fantastic earnings growth. It's the whole new paradigm, brave new world. That doesn't last forever. So when these are all grossly overbought as they are now, then I think you have to apply a little bit of caution in your portfolio. Sometimes it's not how much money you make, but how much money you don't lose that determines your long-term returns. And I think we're in exactly that kind of market condition right now. Now, on to the article, and this was in the Financial Times this morning. It was about the Super Return Conference that was held in Europe last week, and that's where all the big private equity guys get together and talk about what they see going on in the world, and I'm sure they network and do all that stuff. But it's one of the biggest private equity conferences in the world. And the Financial Times noted that a lot of these guys are having a fantastic time, easy time raising money. There's already a lot of dry powder, and valuations are elevated, and we're starting to see some stupid deals get done. We're seeing deals being done at an enterprise to beat a multiple of 10 and higher. Those usually don't pay off very well. We're also seeing more leverage in the system. People are levering up to get the returns that their investors have come to expect. We worry about the bankers doing something stupid, but I'm seeing some stupid things go on in the private equity world and the private credit world too. That could cause as much damage as stupid bankers. So we're going to be keeping an eye on that. These 10 plus multiple deals are a sign of a market top, and a big private equity deal blowing up could cause serious problems for the overall market. Now, right now, as I sit here and I look at the world, and I've said this several times this year, I don't see a valid reason for stocks to go down. But with stocks at very high levels and stupid risk taking on the rise, if the market does find a reason to go down, higher interest rates, Putin doing something stupid, heating up of a trade war with China, something out of North Korea, too many interest rate hikes, the Fed getting a little more aggressive in their hawkishness. if the market finds a reason to go down, it could go down hard, fast, and ugly. So we need to be aware of that. There's stupid risk taking. Valuations are very high. Traditional historical indicators are also very high. So if you don't have a highly developed sense of caution right now, you could come in for a rude awakening sometime over the next year. We just started. We got all the call reports in. All the earnings reports are finally in. We got them piled up all over the desk and stacked up on the computer. And we're starting to go through the entire portfolio and do a full hands-on evaluation of each and every bank in the portfolio. I haven't done this in a while. I'm going to do something different. I usually do this once a year. I don't usually send everything out to subscribers. I'm going to go ahead and send you guys just a little write-up, kind of an idea of exactly where we are. Because we found some really interesting things. Okay, we found some banks that are a little more expensive than they appear to be at first glance. That they may be reaching points where they are fully and even overvalued. Equally interesting, we found a lot of banks that we look at first glance and say, okay, that's just okay. And then we dig in deeper and we go, oh my God, this is a lot cheaper than we thought it was. So we're going to be sending the results out. The first 15 should be done by the end of the day today because we worked on this pretty good over the weekend. And we'll get them typed up, get those sent out. And then every couple of days, we'll get you a few more rather than hold it all for one big final glorious report. We'll just kind of piecemeal it out to you guys. This is going to lead to a little bit of rejiggering in the portfolio. Some of these banks that are more expensive than they appear to be, well, we're going to sell those. And we're going to reallocate those funds back to some of these banks that look like they're above our buy point, but are actually well below where we should be buying, and they have fantastic upside over the next 12 to 24 months. So there will be a little bit of repositioning. The buy list is probably going to get a little bit bigger, although we are not abandoning our allegiance to cash in the hedge right now, but we are going to reposition so we own the stocks with the most upside in the portfolio. We have, for the last 4 years, been hunting with a shotgun because all banks everywhere were cheap. It's worked really well. We've thumped the market by a pretty wide margin. We have the only portfolio in existence that I'm aware of that's available in a newsletter that has absolutely no losses. We've never taken a loss. We have one stock that's down by a little bit less than 10% in the portfolio, and that's the only one we have down. And by the way, it's worth almost twice the current price. There's an activist investor involved. We don't think we'll ever close that out at a losing position. None of the stocks that we will be closing out because we think they're overvalued, based on this little more in-depth view, will be closed out at a loss. In fact, many of them are going to be closed out as triple-digit winners. So there you have it. We have been hunting with that shotgun, and it's been fantastic, but the market's really elevated. Interest rate conditions and economic conditions look like they may be changing a bit here. Credit's as good as it's ever going to be. It just can't get much better. Incrementally, maybe, but a dramatic positive improvement in credit would be impossible. It's as good as it gets. So we could be nearing that mean reverting portion of the credit cycle where loan losses change. So we're going to rejigger the portfolio a little bit in weeks ahead, and we'll be sharing the analysis and, of course, the buy and sell signals with you over the next several weeks. Haven't been very active in the last year. That's going to change just by about a little bit in the weeks ahead based on the research that we've been doing. Okay, now, NCAA time. I'm going to start digging in here. I'm going to change my whole approach. For years, we did pretty well using Sagarin rankings and a few other analytical tools to pick teams in the tournament. We did okay. I usually finished in the money in the pools that I was in. The last 3 years, that really hasn't been the case. It's been horrible. So what I'm going to do, I'm not going to look for the winners. I'm going to look for the way to blow up my bracket as quickly as possible. Okay, that's what has happened in reality in the past 3 years when I've tried to pick the winners. I was usually out of competition sometime on the first Thursday of the tournament. So I'm going to look for a way to blow up the bracket just as quick as possible and see if that doesn't lead to us finishing in the money this year for a change. So anyway, also getting ready to start my baseball analysis. Now, we've done a lot better there. We've picked division winners, World Series winners, pennant winners in both leagues for the last several years. And if you've been doing baseball futures bets based on the analysis you've done pretty well, which, by the way, guarantees absolutely that my baseball picks will all be wrong this year. There's just, there's no way that streak keeps up. But I'm going to do it because it's fun to do, and I really enjoy it. And I'll be sharing that pretty much with everybody once I'm done. Expect that sometime in late March. Most of that tends to get done late at night or when I'm traveling on airplanes, when I've got time to just kind of sit down, dig through it, and come up with the teams that I like for the divisions and the World Series and the pennants. Most years, I can find a way to make a case for the Orioles to at least get in to the wild card spot. I cannot make that case this year. Position players, I love our position players. Manny Machado coming into his walk year on his contract, he's going to have a monster year, and he's flashing signs of that already in spring training this year. Chance Cisco, the catcher, he's major league ready. You're going to see him up this year. They'll probably do the usual goofy stuff involving contracts, and he may not come up until sometime in April or May, late April, early May. But he's going to be up, and this kid is a good catcher, and he can flat out hit. Really excited to see him coming up in the majors this year. Trey Mancini, looking to become a consistently very good left fielder. Again, he can hit. He's got a little bit of speed. Really looking forward to see him continue to develop this year. Jonathan Scope, he started towards superstardom last year. He's going to complete the march this year, and he's going to be in the conversation as the best second baseman in the game today. So position players, I like the look of the team. Pitching? Nope, doesn't look good. Kevin Gausman threw a great game yesterday. 3 scoreless, no-hit innings. Brought his ERA all the way down to 15 this spring because in his first outing he got absolutely shelled. So did Dylan Bundy. Nobody else has showed much on the mound so far. Now in spring training, you can win a lot of 10-8 baseball games. In regular season play, when you're facing actual full-time Major League Baseball pitchers, you're not going to win a lot of those games. Certainly not enough of those games to even be in the discussion for the wild card, much less the division win. So I'm not holding out a lot of hope for the Orioles unless they are able to do something dramatic or lightning strikes and Bundy and Gausman both reach ace potential. I'd love to see it. They're both great young guys. They've worked hard, but they just have not been able to consistently deliver so far. It's going to take a lightning strike for the Orioles to do much. I'll still be watching. I'm just MLB app renewed the other day. I've got it on my phone, walking around, and it's, kind of like this walking. I look like a teenager. I'm not texting or anything, though. I've got my baseball game on, and I'll usually have it on here in the office. We're playing in the radio when I go out to walk the dog. So it is baseball season. I am a baseball fanatic, and away we go. Get a pretty good idea who we like for the divisions, but we'll go ahead and crunch the numbers and see what it actually looks like. Have those results for you later this month. Okay. On the book front, we are almost done. The Chernow book on George Washington. It is a lengthy book. However, it is a lot of fun to read. It's been fantastic, very enjoyable. Almost done with that. Our next 2 picks on the nonfiction side are going to be Nassim Taleb's Skin in the Game. Huge fan of Taleb. Huge fan of Skin in the Game, especially when it comes to investing. I have always done well investing in companies, particularly banks, where insiders have significant ownership and they stand to make as much as I do, or lose as much as I do when they screw up. So Skin in the Game, looking forward to that. And then Annie Dukes, Thinking in Bets. She's one of the best poker players in the world. She's part of a think tank of poker players that involve some awfully big brain folks that sit around and talk about odds and probabilities and life and markets and cards. And she's going to share some of the insights in this book. And some people I really respect have already read it and have given it very positive reviews. So now, before we go, we'll touch on Colony North Star. It's a stock I recommended in the deep value portfolio and on Real Money over the past several years, referring to it as a forever stock. Yes, it blew up ugly based on that earnings report. The investment management business has just been horrible. Blackstone killed them in the closed-end real estate retail offering segment. They came up way short of the numbers that they expected, simply because Blackstone was more aggressive pushing their product and they had much wider public marketplace assistance. Now, the key for me on this call, because the stock got absolutely hammered, as many of you know, as I listened to the call and I read the numbers, the investment management business is horrible. The assets on the balance sheet, however, are still there. There's real value there, and it's way above the current stock price. Now, they did, because they disposed of the portion of the debt portfolio that was commercial mortgages and contributed it to the new REIT, that CLNC, of which we as shareholders own 37%, substantially reduced the balance sheet yield, and they've chosen to focus more on total return. So they had to cut the dividend. Am I happy about that? No, not really. Am I terminally upset? No, not really. In fact, the day of the earnings report, we bought a little bit more of that particular REIT for long-term accounts. It's still a forever stock. I still think they have fantastic management. Most importantly, they all have skin in the game. Tom Barrick is the one of the largest shareholders, and he led off, that's the chairman, by the way, led off the call by saying that, look, his money, his family's money is in that, their reputation is in that. And the phrase he used I thought was interesting, that was that his reputation will not be tainted much longer. He intends to get very hands-on the money management side of the business. That bodes very well for this company long term. So if you own it, I suggest buying a little bit more. Buying after a dividend cut has historically been a pretty good move, particularly with real estate investment trusts in my experience. So I think I would go ahead. The selling is way overdone. The value is much higher than the current price. I still have it as a forever stock, and I expect my granddaughter's daughter to be able to use dividends from Colony North Star to pay for her college. That's how long I intend to own the stock. So is it fun to have a stock go down like that? No, but I've been here before. Atlas Pipeline Partners comes to mind, where it went from 21 to I think 3 before we got out in the 30s. Kahn's Department Store went from 12 to 3, and then boom, to the moon. So I've got dozens of examples of stocks that have blown up and then recovered, moving well past our original purchase price. I think this will be another one. I'm not losing any sleep over it, and I guess you should probably go ahead and buy more. I think long term, this works out exactly as we originally expected. So anyway, that's all from me down here in Central Florida. Got to get the dog out for a walk on what is actually a gorgeous day. It's going to be about 72 degrees. There's a nice breeze blowing. Kind of a welcome little break from the high 80s that we have experienced. I'm not real happy about Thursday because it's only going to be in the 60s, so I may have to stay inside all day. But that's the price we pay for living down here in the Sunshine State. Anyway, that's all out of me. I've got to get back to work crunching some bank numbers. So I will talk to you guys next week.